$4,300 per ounce of gold, 45 all-time highs in 1 year. Central banks bought over 1,000 tons 3 years running. And on October 17th, U.S. regional banks crashed. Bad loans. Goldman Sachs warns of $5 trillion in credit risk. Moody's rushed to calm the markets. October 30th, the Fed meets. Cut rates, inflation comes roaring back. Hold rates, banks collapse. A trap. Today, I'll break down what's happening to the financial system, why silver skyrocketed 78%, and which of 4 scenarios the Fed's decision will trigger. Stick around till the end. I'll show you what central banks know but won't say out loud. Let's start with the numbers. Gold went from $3,500 to $4,000 in 36 days, September through October 2025. For perspective, from 2000 to 2011, gold climbed from $300 to $1,900 over 11 years. We just saw a comparable move in a month. On October 15th, gold's market cap jumped $300 billion overnight. An entire Netflix added in one night, 45 all-time highs since January. Every week, a new record. The market is repricing reality in real time. Silver is even more striking, 78% gain for the year, $52 per ounce. The last time we saw these prices was January 1980, when the Hunt brothers tried to corner the entire market, 45 years ago. But this is a different story. 5th consecutive year of physical deficit. Demand exceeds supply. In London, traders talk about zero liquidity. Physical silver simply isn't available. And here's the key. Silver outpaced gold in percentage gains. Historically, the gold to silver ratio sat at 15 to 20 to 1. Right now, it's 80 to 1. Either silver is undervalued by a factor of 4, or the market sees something we don't yet understand. While everyone debated Bitcoin and digital gold, central banks did the opposite. 2022, 1,082 tons of gold, the highest since 1967 when the gold standard still existed. 2023, 1,037 tons. 2024 and 25, the pace hasn't slowed. Just in August, 19 tons. We're not talking about one-off purchases, we're talking systematic global accumulation of physical metal. Poland became the largest central bank buyer in 25. The National Bank of Poland publicly increased its target allocation to gold reserves, a direct statement. We don't trust the system's stability. We're moving to hard assets. India pushed gold reserves past $100 billion for the first time ever. The Reserve Bank of India was actively buying all year. China, 11 consecutive months of purchases. The People's Bank of China doesn't publish details, but the fact stands, 11 months without pause. When the world's second largest economy buys something nearly continuously for a year, that's strategy, not tactics. Historical context is critical. From 1999 to 2009, central banks sold 4,000 tons of gold, dumped it. Gold was considered a relic, a useless, non-yielding asset. In 1999, they signed the Washington Agreement, how to coordinate gold sales without crashing the market. They agreed to cap sales at 400 tons annually. Central banks were figuring out how to safely offload gold. The reversal came after the 2008 crisis. Trust in the financial system cracked. By 2010, central banks became net buyers of gold. After 2020, purchases exceeded 1,000 tons annually, gold standard levels. What changed? The same institutions that dumped gold as dead weight 20 years ago are now buying aggressively. Why? Officially, reserve diversification. In reality, a crisis of confidence. 2022, Western nations froze Russia's currency reserves, hundreds of billions wiped out by political decree. No trial, no compensation, no warning. Every central bank got the message. Dollar or euro reserves can be locked at any moment. Gold on your territory can't be frozen, can't be zeroed through SWIFT, can't be seized remotely. It's genuinely yours as long as it's in your vault. The US-China trade war is escalating. October 17th, markets reacted with volatility to Trump's announcement of new tariffs. Each escalation signals to central banks. We need insurance against political unpredictability. Gold is an asset no single government or currency zone controls. That's why central banks are buying massively and silently. But if central banks are hedging with gold, why is the US banking system cracking? October 17th, Asian financial stocks tumbled, especially in Japan. The reason? US regional banks crashed the day before, rising bad loans. Credits aren't being repaid, companies are defaulting on major loans. Moody's issues a statement. The banking system is stable despite concerns. When a rating agency publicly reassures with everything stable, there's plenty to worry about. Mark Pinto, head of global private credit at Moody's, gave an interview to CNBC on the 17th. Quote, "There are concerns about weakening underwriting standards. When large companies default on very large loans, it leads to massive write-downs and bankruptcies. Regional banks are trapped, too small to compete with JP Morgan, too slow to fight fintech. Net interest margins are compressing. The cost of attracting deposits is rising as customers move to high-yield accounts. Loan yields are falling due to defaults. Classic squeeze." October 16th, Goldman Sachs warned of global credit crisis risk. The volume of distressed assets, $5 trillion. Japan's GDP is around $4 trillion for comparison. Where are these $5 trillion? Corporate sector, non-bank institutions, hedge funds, direct lending funds, financial platforms that grew over the last decade. October 14th, the IMF published research on non-bank sector risks. Key point, growing interconnectedness between non-bank institutions and traditional banks will amplify the spread of negative shocks. In plain English, when one piece falls, the whole chain goes domino. The Federal Reserve is trapped trapped with no way out. October 16th, Fed Governor Christopher Waller stated support for a rate cut at the October 30th or 31st meeting. Reason: the labor market is weakening. Unemployment is rising. Without rate cuts, the economy slides into recession, mass layoffs, contraction. But the main problem? Inflation remains stubbornly above the Fed's 2% target. According to public surveys, inflation expectations run 6 to 7%, a massive gap between Fed statements and reality in people's wallets. Cutting rates with high inflation expectations will reignite inflation. Trump's tariffs add pressure by making imports more expensive. Waller acknowledged the conflicts. Quote, "If we act too quickly, we may leave the inflation problem unresolved and face its return. If we act too slowly, we'll see unnecessary job losses and contraction. A trap. Cut rates, inflation. Hold rates high, recession and banking crisis. Either choice has consequences. Time is short. The October 30th or 31st meeting is 2 weeks away. Decisions need to be made now." October 14th, Jerome Powell hinted the Fed is approaching the moment to halt balance sheet reduction. After 2008 and 2020, the balance sheet ballooned to $9 trillion. Right now it's $6.8 trillion. Quantitative tightening means withdrawing liquidity from the system. Powell stated, "We may hold reduction in the coming months. If the Fed stops balance sheet reduction and aggressively cuts rates simultaneously, massive liquidity injection, inflations, dollar weakness." Another signal for gold to rally. Where did this situation even come from? Why is everything collapsing at once? The root of the problem is foundational. US national debt exceeded $35 trillion. Corporate debt at all-time highs. Consumer debt growing. The system is built on debt. It holds together on trust that the dollar will maintain purchasing power. But the math is brutal. 1971, Nixon ended dollar convertibility to gold. An ounce cost $35. Today it's $4,300. Gold didn't become 123 times more valuable. The dollar became 123 times weaker. Since 71, the dollar has lost 99% of its purchasing power relative to gold. The US transformed from a manufacturing economy to a financialized one. Instead of goods, we produce financial products, services, debt obligations. Trade deficit runs hundreds of billions annually. The country consumes more than it produces. The imbalance is covered through debt sales, capital attraction, currency issuance. This model requires constant trust growth. The moment trust wavers, the structure becomes fragile. Official inflation sits at 3 to 4%. The Fed talks about a 2% target. Reality is different. Groceries are up by double digits. Housing significantly more expensive. Education, healthcare, insurance, all rising faster than 3 to 4%. The consumer price index has been repeatedly adjusted, volatile components excluded. Result: officially inflation appears managed, but purchasing power is actually falling. Public inflation expectations run 6 to 7%, a huge chasm between the Fed and reality. The billion-dollar question: if the system works, why are central banks massively buying gold? A combination of factors created the perfect storm. Geopolitics, US-China trade wars, Middle East conflicts, frozen reserves. Each turn of tension pushes towards safe haven assets. Crisis of confidence in fiat currencies. Central banks simultaneously print money and cut rates. Trust in paper collapses. Banking system, bad debts, non-bank sector risks, compressing margins, sense of fragility. Inflation expectations. Even if official inflation declines, expectations remain high, and gold is the historical inflation hedge. Silver has an additional driver: industrial demand, electronics, solar panels, medical equipment. Technology grows, silver demand grows. Fifth consecutive year of physical deficit. Demand exceeds supply. In London, zero liquidity. It physically doesn't exist. When demand exceeds supply, prices inevitably rise. Silver combines monetary functions with industrial utility, a unique combination in the current environment. What about Bitcoin? Many said digital gold, decentralized, the future, reality. Since the 2021 peak, Bitcoin lost 30% relative to gold. Central banks aren't buying Bitcoin, they're buying gold by the ton. Talk of strategic Bitcoin reserves stayed talk. Why? Cryptocurrencies are high-risk assets with extreme volatility. Central banks need stability and universal liquidity. Gold, yes. Bitcoin, no. Digital gold failed when the real confidence crisis hit. What happens next? Where does this lead? There are 4 scenarios, and each depends on the Federal Reserve's decision on October 30th. Let's start with the least likely but most optimistic: soft landing. Probability 15%. The Fed successfully balances rate cuts with inflation control. They cut carefully in small increments without stoking inflation expectations. Banks adapt to the new reality, write off some bad loans, tighten lending standards, but survive. Trade conflicts between the US and China gradually ease. Both sides reach a compromise. In this scenario, gold stabilizes in the $400 to $4,500 range per ounce. Silver consolidates after the sharp rally, possibly pulling back to $45 and holding there. The financial system remains relatively stable, though with higher risks than before. Why only 15% probability? Too many conflicting factors at once. Too narrow a corridor for central banks to maneuver. Too many political variables the Fed can't control. History shows when systemic problems accumulate over decades, resolving them smoothly is nearly impossible. Scenario 2, inflation spiral, probability 40%, the most likely scenario right now. The Fed finds itself forced to cut rates aggressively due to labor market weakness and pressure on the banking sector. Regional banks start announcing serious problems. Several mid-sized banks require government support. The Fed responds with massive liquidity injections and sharp rate cuts, but this reignites inflation with renewed force. Consumer prices begin rising at accelerated rates. The dollar weakens against other major currencies and especially against gold. In this scenario, gold reaches $5,000 to $6,000 per ounce within 12 to 18 months. Silver follows gold with even larger percentage gains due to the combination of monetary demand and industrial deficit could hit $70 to $80 per ounce. The banking sector suffers from high inflation and instability. Net interest margins continue compressing. Real incomes fall despite rising nominal wages because inflation eats all the gains and then some. Social discontent grows. Political stability weakens. Central banks worldwide accelerate gold purchases, trying to protect their reserves from the depreciating dollar. This scenario is most probable because political pressure on the Fed is enormous. Mass unemployment before elections is politically unacceptable, so the choice will favor rate cuts, even if it means inflation risks. Scenario 3. Credit crisis. Probability 25%. Growing bad debts in the banking and non-bank sectors triggered a chain reaction. Several major regional banks announced critical liquidity and capital problems. One of the large hedge funds or direct lending funds declares inability to meet obligations to investors. Panic in financial markets. Trust in the banking system plummets. Bank runs begin from regional banks into the largest systemically important banks and into cash. The Federal Reserve is forced to intervene with a massive rescue program similar to 2008, printing trillions in new dollars to save the financial system. This undermines dollar confidence even more than scenario 2. In this scenario, gold explodes to $7,000 to $10,000 per ounce. Panic flight from fiat currencies into hard assets. Silver could go above $100 per ounce for the first time in history. The global financial system goes through a major shock comparable to the 2008 crisis or worse. Why 25% probability and not higher? Because authorities will do everything possible to prevent an open crisis. They'll pump liquidity into the system at early stages, downplay problems, provide behind-the-scenes support to troubled institutions. But the risk remains serious because the scale of problems in the non-bank sector is poorly visible to regulators, and system interconnectedness means trouble can spread faster than authorities can respond. Scenario 4. Correction and new normal. Probability 20%. Gold and silver go through a sharp short-term correction after the rapid rise. Speculators who bought at the highs start taking profits or closing positions at stop losses. Gold drops 15 to 20% from peaks. Silver, due to higher volatility, could fall 25 to 30%. Financial media starts writing headlines like "Precious metals bubble bursts," "Gold rush is over." But the fundamental problems in the financial system that caused the metals rally don't disappear. They remain. So after the correction, prices stabilize at a new, higher level than before the rally began. Gold settles in the $3,500 to $4,000 range, silver above $40. Central banks use the correction for additional purchases at more attractive prices. Institutional investors begin viewing higher precious metals prices as the new normal rather than an anomaly. Gold gradually returns to its role as a significant component of diversified portfolios like it had before '99. This scenario is possible if the Fed finds a way to hold the balance between conflicting goals long enough for the system to adapt to the new reality of higher metals prices and higher risks in the financial system. Now, here's the key point everyone's missing. October 30th through 31st, 2025, the Federal Reserve holds its next meeting, 12 days from now. This meeting could trigger one of the 4 scenarios. Will they cut rates by a quarter point as markets expect, or go for a more aggressive half-point cut, risking inflation, or unexpectedly hold rates steady, fearing inflation risks and risking triggering banking sector problems? Each of these decisions has serious consequences. Markets are extremely sensitive to any Fed signals in the current environment. A small change in Powell's statement wording could cause sharp moves in gold, stocks, currencies. Here's what's critically important to understand. Central banks worldwide have already made their choice. They voted with their purchases, 3 years running, over 1,000 tons of gold annually. Poland publicly raising its gold target allocation, India crossing the 100 billion mark, China buying 11 months straight. They see financial system risks. They don't trust dollar sustainability as the sole reserve currency. They're hedging the only way that's worked for millennia, physical gold. And what are retail investors doing? Most keep chasing tech stocks, meme tokens, the latest AI hype. Gold seems boring, old-fashioned for boomers. But while retail investors think this way, central banks are buying tons of physical metal. Who'll be right in the end? Those managing trillions in reserves with access to information about the real state of the financial system, or those making decisions based on social media posts? Gold at $4,300 isn't just a high commodity price. It's an information signal about the state of the global financial system. When central banks buy over 1,000 tons annually 3 years running, that speaks to fundamental risk reassessment. When silver rallies 78% in a year, that speaks to structural imbalances between supply and demand. When regional banks report rising bad debts and the IMF warns about non-bank sector risks, that speaks to system fragility. When the Fed finds itself between a rock and hard place with no good options, that tells you decades of accumulated problems have reached critical mass. Here's the question everyone should ask themselves. Since 1971, the the dollar has lost 99% of its purchasing power relative to gold. 99%. Why will the next 10 to 20 years be different? What fundamentally changed in how fiat money works? Did national debt get smaller? No, it's at record highs. Did the trade deficit shrink? No, it's massive. Did the financial system become more resilient? No. Goldman Sachs warns of 5 trillion in credit risk. Did the manufacturing base return? No, the economy became even more financialized. So on what basis should we expect the dollar to suddenly become a stable store of value? Politicians' words, central bank promises? History shows all fiat currencies eventually return to their intrinsic value, and the intrinsic value of paper is zero. The only question is the speed of that process. Sometimes it takes decades, sometimes it happens rapidly, like Weimar Germany, Zimbabwe, Venezuela. Current events suggest the process is accelerating. Precious metals perform the role they've performed for millennia. The last line of defense when trust in financial promises starts evaporating. Gold can't be printed by central bank decree. It can't be devalued by inflation. It can't be frozen by political decision if stored physically. It's accepted everywhere, always, regardless of political regimes or economic systems. Thousands of years of history prove this. Silver has an additional advantage. Industrial use creates baseline demand independent of monetary factors. Electronics, solar energy, medicine, technology all require silver. This demand grows as technology advances. Simultaneously, silver retains monetary functions. When gold becomes too expensive for small transactions, silver fills that niche. Historically, the 15 to 20 to 1 ratio wasn't random. It reflected the relative scarcity of metals in Earth's crust and their relative utility. The current 80 to 1 ratio is an anomaly that will eventually correct. We don't know which scenario will play out in coming years. Perhaps the Fed will actually find that delicate balance and achieve a soft landing, though probability is low. Perhaps inflation will return with doubled force and gold will go to 5 to 6,000. Perhaps the banking system will face a new major crisis and metals will explode even more. Perhaps after a correction, a new normal will establish with gold around 4,000. But we know one thing for certain. Gold at $4,300 and silver up 78% for the year. Not coincidence. Central bank purchases exceeding 1,000 tons 3 years running. Not coincidence. Goldman Sachs warnings about 5 trillion in credit risk. Not coincidence. The trap the Fed finds itself in. Not coincidence. These are symptoms of deep structural problems that accumulated over decades and are now manifesting simultaneously. The financial system is undergoing fundamental transformation. The unipolar world with the dollar as sole reserve currency is fading. The era of cheap money and endless debt growth is ending. Trust in fiat promises is weakening, and precious metals are returning to their historical role. Financial insurance against systemic crisis. The Fed's October 30th meeting will show how quickly this transformation occurs. Aggressive rate cuts will accelerate the process through inflation. Holding rates high will accelerate through banking crisis. Attempted balancing may only delay the inevitable. Central banks worldwide already understand this and are acting accordingly. Poland, India, China, dozens of other nations. They're buying gold not because they believe in the dollar's bright future. They're buying because they don't believe. Question for you. Do you trust central banks that have been massively buying gold 3 years straight? Or financial media that keeps selling the stability narrative? Drop in the comments. What percentage of your portfolio is in precious metals? 0, 5, 10, more. Curious to see how many people are actually protecting their assets versus how many keep ignoring the signals. 90% of investors will learn about the problem when it's already too late to do anything. Which group are you in?